Ho, ho, ho! Kirky Claus here. And we have a little bit of a Santa Claus rally. About a week ago, I mentioned that we probably would get a Santa Claus rally. There was a huge dispersion in the call to put ratio, and it really indicated that as the calls expired on Friday, a couple days ago, that there would be a bullish reset, that a lot of these call positions would be put back on as call positions. So that in the short term, we have the seasonality of December, which sometimes comes from this. Also, end of year 401k contributions, other types of spending in retirement plans. And then the January effect, which is largely driven by retirement plans and resetting of portfolios for the new year. So I think that we are going to get that Santa Claus rally and January effect that I talked about, 6-8 weeks ago, that would probably happen, and that I would use that to reposition my portfolio. So we are going to talk about that a little bit today. I just wanted you to pay attention to the chat. If you're not in the chat rooms, now it's a little bit more active at Margin of Safety Investing because we have less over here posting all the big updates. There you go. Talked about Unusual Machines a couple of days ago and Arrow Group. And he did that right after I posted some articles. And then today he posted the link to the new contract that Rocket Lab was awarded. So why don't we talk about Rocket Lab to start, and then we'll go back to stocks of the week and kind of work our way through it. So this is a stock that we bought at $3 and $4 a share initially, and we rode it up into the 40s and 50s. I've been selling covered calls, and then on these dips, I've been closing the covered calls. And now we have this spike here. And I think that this is an unusually aggressive spike that you probably can trim into or sell some covered calls. Now, remember, my estimate on this company is that they get to $50 billion market cap minimum, but probably $100 billion and maybe $200 billion. They're at almost $42 billion. So they're basically projecting out business 5 years from now, 4 or 5 years from now, that brings them in revenue, and they're attaching it to today's valuation. Why do I say that? Because they're not making anywhere near enough money to support a $41 billion market cap. That would indicate, that they had profits of about $2 billion a year, and they're not close. So you have to understand that sometimes the market gets ahead of itself. And if you think of this like the Gartner hype cycle, where you get all the hype, you get your early investors, and then you get your narrative traders, and they push it up and up and up and up. And every piece of good news is just like it's new, amazing, could never happen to anybody else type of news that's going to change the world. And then what happens is they start to price it out for 5 and 10 years away from today, right? The profits that they expect 5 and 10 years out. If people go, well, if that's what they're going to make in 5 or 10 years, and I'm already getting that price today, maybe I should trim some. And that's what I'm doing. So I have covered calls sold at $70 and $80. If it doesn't dip, I'll probably get almost all of it called away, and that's fine. And then I'd be out of Rocket Lab at roughly a $50 billion market cap, which was the low end of my target range. Now, you might think, well, you're selling too early. And sometimes I do sell too early. Palantir, I sold way too early, but I invested early. So I had a net cost on Palantir of around $9 a share, sold it between 30 and low 40s when you figure in the covered call premium. And I got a 400% gain, give or take, on Palantir. Now, could have been a lot more? Yes, could have been a lot more. And I will maintain that Palantir, for whatever reason, they have a cult around the stock. It is trading for their earnings 5 to 10 years out right now, and it's been holding. Will that hold through a bear market? No. Will I buy it back during a bear market? Probably. Could I have done a lot less work? Yeah. Could I have made more money? Sure. But 400% is 400% in 2 years, and I can live with that. Now, with this one, it was a 10 bagger. And I've been taking profits at 10 and 12 and 15x. I can live with that. Now, if it goes to 100 billion, people say, oh, you are so stupid to sell at 70 and 80. Well, was I stupid to buy it at 345? A lot of the people who have bought this stock bought it on this rally, right? So they have a net cost in the 20s and even into the 30s and 40s. Your margin of safety comes from buying assets on the cheap. That's all there is. If you want to buy this right now, you are not buying it cheap. Period. End of story. No questions asked. You cannot make a logical, mathematically based argument that it's cheap right now. Now, can you make an argument that it's going to double from here? Yes, you can. But let me ask you something. If you had done the reading and understood this company had a bright future, and you were able to think forward and say, I bet there's some Elon Musk fatigue that helps these guys out. Big contract with the government that Elon Musk and SpaceX did not get. Then maybe I can buy it down here at 345. People go, but it hasn't gone up yet. Exactly, right? I told the story a couple of weeks ago how I wanted a ribeye, and normally, I'll pay for the good $25 a pound ribeye. When I went to the store, the tenderloin was $25 a pound, and the good ribeye was like 65. The ribeye was like 35. And I was just like, screw it. I bought some hamburger and I made some mushroom Swiss burgers and I was happy. So I'm really good at mushroom Swiss burgers. I'm very good at making it. I figured out the sauce. Anyway, with Rocket Lab here, can you hold it? Can you make an argument to hold it? Yes. If you want to be into trying to make the last double, which is a higher risk proposition than making the first 10 bags, I think it's a riskier trade. It doesn't mean it won't pay off, but the odds of this stock going back down to 45 or 50, I think are substantial. And if we get a bear market next year, for this stock to go all the way down into the 20s or 30s would not be unheard of. So this idea that something that looks a lot like the Gartner hype cycle is going to defy what oftentimes happens is just a tough bet to make. So I'm trimming, and I'll sell some cash secured puts behind it. I need to get this stock probably close to 50 to make me feel better about it. I'd like to get it at about a $25 billion market cap. And if the market gives me 25 billion again, I'd probably buy it. And then if they keep getting contracts and it keeps looking like they're going to catch up to SpaceX and the 200 billion market caps becomes more seeable, then maybe I would hold it all the way to 100 billion and get another 4-bagger. So I'm just saying your margin of safety is based on knowledge and price. And my knowledge of this is that the money that they need to make to justify this price, probably around 5 years out, if they execute. If space proves not to be as hard as space has always proved to be. We saw the launch delay for AST Space Mobile recently. Space is hard. I think Elon Musk said that. Space is hard. So, we bought this one down around $5 too, and I was trimming at 50 and I sold cash secured puts. Some of my accounts still have it. Some of them don't. Some of them just have cash secured puts that have expired. Can this stock go to 100? Yes, I think that it can. And that's why the last covered calls that I have written are up at 110. Because there is a cult behind this stock too. Not people who do any fundamental analysis. They're just cheerleaders, rah-rah-ree. And, they might push it up high enough so that the algorithms just burn them at the top. And when it comes down, look at how far it comes down. It moved $30 down here in a couple of weeks, $20 down, $15 down in a couple of weeks, maybe a couple months in this one. So the idea that it can't take a sharp digger is silly. Now, their current market cap looks like about 40 billion, a little under 40 billion, 35 billion. You can make an argument that you should be holding this to 100. I get it. That's why my cover calls are at 110. Am I buying it right here? Nah. Would I buy it down here? Maybe. Again, this is another one where I feel pretty good about it at 25 billion. I don't know how I feel about it at higher. And the companies have different debt structures. So even though they seem to be moving pretty in tandem, the cult of personality of each stock is similar. They both are part of the space mob and things like that. So this is a tougher call, right? Do you hold it all the way to 100, 110? I think probably you do. I think that there's a lot of technical support for that, right? The spike back up here. You have the Elliott wave that goes up to around 110. This is basically the area that I'm targeting. But then I think it comes all the way back down to around here. And in a bad macro environment with a bear market, who knows, right? We could wash out all the hopium. All right, so I wanted to update the space stocks because a lot of people ask about them. All right, so I published Stocks of the Week. I covered our experience with Warner Discovery and then the SMID caps because I wanted to really kind of emphasize how I'm thinking about things. One of the ideas in investing, and this is, I think, important to understand, and for those of you who have been through this with me before, it'll be a little repetitive, is that in large caps, you have an efficient market, meaning that most information is priced in relatively quickly. It is difficult in an age where half of the money is indexed and probably over half of what's left is quasi-indexed to really find an edge in large caps. You're really just riding the trend, and the trend is more or less liquidity driven. So with large caps, picking a large cap stock, I mean, maybe there's 10 or 20 of them a year in the S&P 500 where you can say, oh, I think I understand this better than the market. But because the indexers are just indiscriminately investing in everything, sometimes it doesn't even matter then. So the bigger stocks get the most money. When they come down, sometimes it has a snowball effect. But if liquidity is high, they usually rebound or stabilize relatively quickly. It's when liquidity dries up that the large caps really get beat up because they're big companies. It takes a lot of money to hold those stock prices up. The other way that I have invested and done well is long-term investing in catalyst-driven small and mid caps with asymmetric upside from a low price or a margin of safety price. If you've read The Intelligent Investor, which I've told everybody to read, I've begged everybody to read, I hope that you're all reading it, have read it, then you know that margin of safety, again, is from buying a good asset on the cheap. And by buying it at a lower price, because you understood it, right? You can't just buy cheap because it's cheap. Sometimes things are cheap because they should be cheap. But if you can identify the near-term future of a company, right? 2, 3, 4, 5 years out with some relative accuracy, you don't have to be precise, then what you can do is you can buy on the cheap and then you just wait. And as Charlie Munger said, the money is made in the waiting. So I have done things both ways. When I don't have large ETF positions, right? When I don't own a lot of QQQ or the momentum S&P 500 or the momentum mid caps, it's because I think the market is weak and that liquidity might be, drying up. I don't do a lot of 1 and 2 month trades. Otherwise, I could probably ride the Santa Claus and January effect rally for the next month or so and own QQQ and SPMO in particular. I think that that's the one that I am leaning towards right now, and XMMO, right? So the momentum versions of the indexes, the S&P 500 index and the S&P 400 mid-cap index. So as you work your way through this article, we talk about things like money supply. Now, world money supply, the major central banks just started to turn over. There is a 6 to 12 month lag between when the money starts to tighten up and when the stock market starts to get beat up. So sometime between early 2026 and the middle of 2026, maybe autumn, if this doesn't turn back up, and you saw that in a lot of places it does, then maybe there will be a liquidity crunch. At a minimum, even if this goes sideways, where does the new money come from to push stock prices up? Especially since we saw unemployment tick up a little bit. What you really need to understand is that the central banks enable the banking system to lend. That's how it works. So when the Federal Reserve prints money or loosens up, lowers interest rates, reduces reserve requirements, when the Treasury reduces liquidity requirements on the banks for the amount of cash reserves they have to hold for potentially bad debts, that can push money into the lending system because the banks say, oh, we have less requirements from the government, or the Federal Reserve is supporting us with cheaper money, we can lend more money. I told you 6, 7, 8 months ago that I got another wave of credit dumped on me. So back, 2021, I told you that I was given like $100,000 in credit card limit. I got like another 50,000 this year. And I don't really even ask. They just, they send the offer. I take a look at it. I'm like, well, okay, hey, I can use this maybe somehow for points or whatever. I'm a big points guy, even though it's kind of sport at this point. But and the benefits of the travel cards are pretty cool. The banks lending actually account for 80 to 90% of overall money supply. So while the central banks are doing what they're doing, it is actually the banking system that lends out the money. And if they are lending, money supply goes up, liquidity goes up, more money that can flow into the economy and to the markets. And if the banks aren't lending because the central banks tighten up, or because we enter a period of fiscal dominance, any of you who read Lynn Alden or Luke Grumman, like I do, know what that means. That means that the debts are getting so big that financing the debt and the deficit on top of it is getting to be very difficult. And we've talked about how the debt structure, the term structure, has condensed so that in the next 3 years, we have middle 30s in trillions, so say 35 trillion-ish, that has to be financed. We've never come close to having to finance that, and we don't have close to that much money. So we're going to be $3, $4, $5 trillion a year short on the amount of money that we can finance. So we're going to have to borrow it from someone or something, or we have to print it. And I believe that all roads lead to QE, but maybe it's not as V-shaped the next time as it was the last couple of times. So as you go through the article, you'll see that total debt has gone up. You may have seen a recent chart that margin lending to buy securities has gone up. The amount of money lent to private equity, business development corporations has skyrocketed. If the earnings and cash flow don't develop fast enough to service the debt, then what happens? Then people start to slow pay. There was an article in Bloomberg yesterday, maybe, that talked about why are people not paying their car loans? Why are car defaults going up? I've been talking about that, for 6 months now? So you really have to consider how much risk do we have? How thin is the ice underneath the financial system right now? If we have M2 liquidity rollover because the central banks can't get looser, because debts are hard to pay, because the banks start getting a little bit out over their skis, which they are, then we could have a problem. I think that happens in 2026. If it doesn't, it happens shortly thereafter. I'm not sure how long they can float the debt. We've already floated the commercial real estate debt, so that debt has also compacted, with about $1 trillion due in 2026. Almost, 2/3 of it at regional banks. There's going to be a region. You can mark this one, bookmark this one. There will be a regional bank that collapses in 2026. And in fact, I think there will be 2, 3, or 4. It'll be a lot like the last time it happened. And I don't know again, given that the administrations are different, that Steve Mnuchin is out there just looking to buy up distressed assets, and some other investors are too, I think that they let them, burn. I really do. I don't think you see the stocks get bailed out. I think the executives lose bonuses. I think it ends up actually being like the last time, except they might not bail out the depositors. And that would be interesting. So the last time they bailed out the depositors and nobody else, this administration, I'm not so sure that they bail out the depositors beyond $250,000. So we'll see how that plays out. Companies need to be very careful about how much money they're keeping at banks. And I'm not so sure that the sophistication level of CFOs at a lot of small and mid-sized companies, and even some big ones, I don't think that they necessarily manage their risk as well as they should. And a lot of them think, well, if I'm with one of the big banks, I'm okay. Well, I don't know. I've told you over and over again, Citigroup bankrupts themselves all the time. They've essentially bankrupted themselves 3 times in my lifetime. So, who knows? I don't think Bank of America is in great shape. I think Citigroup is the one that I would worry about the most. And the regional banks, there's clearly dozens of regional banks that are at risk. I mean, there's a list. So if there's a list of banks that are at risk, you can be sure that one of them gets beat up. Because the large caps are efficient, right? And I talk about that in here. In financial theory, a market is defined as efficient if asset prices fully and instantaneously reflect all available information. In an algorithmic era, that's not perfect, but it's close. So we have a very efficient market in the large caps because everybody studies them and money flows in through indexes. And then the algorithms trade it back and forth and they hedge it. When the hedges break, that's when you get your limit down days and you get big outflows of money from the market. I think it's very hard to invest in the ETF. So I mentioned earlier, if you were nimble and you're paying attention to this stuff, you can maybe use the ETFs to ride the rally a little bit. The problem is that most people aren't good traders. So for most folks, I would say, don't try to trade the 1 and 2 month trend. Wait for something that's a little bit safer and a little bit more predictable. Small and mid caps, on the other hand, unlike large caps, are not an efficient market. There is no regular flow of money in there because so much of the money is thrown into large caps. The Russell 2000 index, which is the 2000 biggest companies after the first 1000, 70% of those companies, give or take, are unprofitable and always will be. So I hate this index. This is actually an index that you can short if you're looking for something to hedge. And in fact, we will take a look at that here. Let's take a look at IWM. If you really want to hedge, this is the one to hedge because it is a shit index. And if liquidity tightens up, while some of the best stocks will still do well, the vast majority, 70% or more, are going to get beat up. There. I don't make my charts as pretty as they should be sometimes. Very unlike Teresa. Teresa's charts are much prettier. So when you take a look at some of these rallies in IWM, right, they go up and then they crash, go up and then they crash. And since COVID, so much of the money has gone into large caps. But during the easy money era, right, when they just printed money, they went almost straight up. But then had about a 40% correction, jitterbug, big rally, about a 30% correction, and now another big rally, and it's almost stretched out of its trend range. So could IWM through early next year, make a run at even 300? It could, but when liquidity dries up and all these unprofitable companies have a problem getting financing, then it comes crashing down. So if you're going to try to time a short, and you have to time it, you can't be early because it costs too much money. If you want to try to time the peak, this is probably the index you do it in. The oscillator has given you the red dot. And the red dot is what? Pay attention. the oscillators are starting to change. Now, if it manifests in a down arrow, probably want to sell. That's your signal. If you want to be real aggressive, that's when you can short. So here's a down arrow, right? And you got your big correction. 21. So those really were your last big down arrows. These here are the Wyckoff signals, and the Wyckoff signals have been really good too. So you can see that every time Wyckoff signals down, it either goes down or chops sideways. And every time it signals up, it either goes up or chops sideways. So not a bad equation, right? I mean, you can tie or win either way. So we got the Wyckoff signal for a rally. We're starting to see a change in the oscillators, right? The slow change of direction. So when things are accelerating, the curve bends up. When the things are slowing down but still going up, it starts to roll over, right? So what that signal here is telling you is that starting to roll over, not confirmed yet. It could still rally again, which I think it will. But then the next time, it probably doesn't just give you a warning. It probably screams at you. So if this rallies up into here and you want to be very exciting and take a lot of risk because you think you're going to hit a home run, or because you want to hedge a lot of or because you want to hedge a lot of long positions, then maybe you can buy a couple of puts up here. For most people, not a great idea. So in my opinion, when the large caps are overtly challenged by liquidity, and because we don't want to invest in the small cap index anyway, the place to find winners is in the small and mid caps that are catalyst driven, that have a lot of upside from executing their business. 1 second, please. My dog's going nuts. All right. This guy was yelling at somebody. Say hello. No, over there. Over there. Over there. This way. You'd be obstinate. Go lay down. Stop yelling. All right. Sorry about that. You just have to get the last word in. Go lay down. I bet Amazon just dropped something off. He is a Jack Russell and Chihuahua mix. So somebody decided that they would breed the most nippy dog with the third most nippy dog. So they bred a jerk with a jerk, and you got jerk squared here. So it is what it is. Yeah, he's pounding the table on something. All right, let's see here. I'm not really sure where I left off. So in any case, my opinion is that the place to invest when you're not sure about large cap liquidity, and given that you really can't invest in the small cap indexes, and during those big rallies you can, but why wouldn't you just buy a dozen mid caps and double your upside or triple your upside, which we did with ASTS and Rocket Lab and Palantir at the time, right? So those are the sorts of things you can do. Going back to our experience with Warner Brothers Discovery, had to relearn some lessons. And I think the main lesson here to learn is that we probably should have waited to buy this. Now, when I wrote about this initially, Kirk Stradamus, I said that after the AT&T spinoff where they merged with Discovery, that it was going to be one of the must-have streaming services. And that's proved to be true. They have 3 massive offers to buy this company, from Netflix, from the new Paramount Skydance, and from Comcast. So clearly valuable assets. And I started buying in the 20s, and ultimately I finally bought some around 10. I trimmed it, cut my losses. Haven't really made a profit on this one. I know a few of you have that just held it all the way through. And, you know, you learn, you live and you learn. So even though I correctly said that these companies would both be for sale, Paramount and Warner Brothers Discovery, it didn't matter. I mean, we basically broke even on Paramount. I think that basically we're breaking even on Warner. For those of you who just round tripped it, you're actually up because you scaled down. You know, maybe you've made 50%. I know one investor that has. And I think the lessons here are that seen into the future, even though I was accurate, I wasn't accurate enough to actually make money. And that's going to happen once in a while. In hindsight, I should have waited for this stock to bottom out or get close to a bottom. The long-term charts told me that $10 a share could happen, give or take. And I was like, but it won't. Well, it did. So I really should have waited for management to squeeze out the profits, push down the debt, pay off some debt, piss enough people off, and then settle around that $10 that the chart said it might get to. Because sometimes things will happen that shouldn't happen, but they do. The charts give you a clue, right? The charts aren't 100% predictive. They never are, but they give you clues. And when it shows you a giant downside, you should ask why. Who sees that something horrible could happen to make a certain chart pattern appear, or to have some algorithm tell you, hey, it probably doesn't go down there, but it might because somebody's betting on it too. And if somebody's betting on it to get clobbered, you really should ask why. Because the shorts are generally pretty smart. The good shorts are pretty smart. So the long-term chart said that a price around 10 could happen if, say, a money-grabbing CEO went scorched earth on what was the company at the time so that he could sell it later after he wrote his compensation package. And that's actually what happened. So again, I use this as a teaching tool because I didn't really get beat up on Warner, but I didn't make money. I wasted a lot of time. I had to do a lot of work. And had I just waited for the chart to play out and not tried to catch the falling knife, I'd have done really well. If I had bought this at 10 and looked at his contract, which said at 17 he can sell it out, he can get it bought out and make a bunch of money, I would have been able to go, well, if I buy it around 10, I know it's going to 17, and we'll see what happens above that. So I should have been able to make 50, 60, 70% on this with a lot of work. Now, here's what'll twist your noodle. If I had known that that was the sort of thing that could play out, I probably would have never gotten involved. Why? 50, 60, 70%? Who cares? I can invest in Microsoft and Google and make that kind of money. Why do I need to take the risk of a high debt company? So there's a lot of things that were kind of against my rules here, and I did it anyway because I understood the company, or so I thought. Didn't really think the worst case scenario could play out. It did. And I wasted a lot of time. So just use that as a lesson. Now, back to a little bit about S&P 500 stocks. I dropped this in here with the Warner Brothers Discovery as part of the point of, pay attention when something hits you in the face. This is the dispersion of returns based on the S&P 500 forward PE ratio. When the forward PE ratio is low or in the middle, the forward returns are generally double digits. As the PE ratio pushes out, and we're the red dot here, the range of returns over the next 10 years is an average of roughly 0. So where the forward PE ratio is on the S&P 500 is right now, basically is telling you that large caps and mega caps could just chop along sideways for a very long time. I have shown an S&P 500 chart not too recently, not too far back, where, and I'll show it again, I have suggested that we might have a giant head and shoulders pattern playing out. I've suggested that we might track all the way back to a price that was last seen in 2021 and 2022, maybe lower. We might see some 2020 prices. No reason this can't extend further down in a debt crisis. But I just show different Elliott wave patterns, essentially, that could lead to much lower returns over time. And these could all stretch out. There's no reason this can't stretch out so that valuations and earnings can converge. So you could see top of the head, shoulder, and then back to the neckline. I mean, we could see prices in the 400s or 300s on the S&P 500 2 times more, maybe longer. We'll see. If we enter a deflationary period, and everybody talks about inflation, and inflation comes from policy, right? Inflation comes from policy. The natural order of things, given our demographics and technology, is for deflation. All of the inflation comes from what we do as a policy response, how we handle regulation, how we handle the M2 money supply, how we handle deficit spending, how we term out the debt. The idea that we cannot have a 5 to 10 year period where things chop along, again, I think is naive. I think it can happen. I'm not sure if it will. But since the QE era, before and after QE, you can see things have changed in the post-QE era. Here's an important thing to remember. For the U.S. to pay its debt, we really need asset prices to go higher. Why? Because compensation and stock prices that rise lead to higher tax revenue. So if we actually have more than 1 year at a time where the stock market is down and unemployment is up, we really could enter into a death spiral. If that happens, I don't know, in the current political climate, and again, I'm trying to be a diplomatic grown-up here, I don't know if we solve things quickly. So that last article I wrote about a potential debt crisis, read it, because I don't make these things up. I read pretty smart people. I try to understand it, and I try to take the things that are most important. So I think that you should be careful when you're investing in large caps, absent a good liquidity story. If liquidity isn't good, you really ought to be concerned. All right. So there are some small caps that I'm accumulating. I'm not going to put them on the screen here, but I will talk about them in general terms. One of the reasons that you invest in SMID caps, if you're a baseball guy, this will make sense to you. I use a lot of poker analogies, so I thought I'd switch to baseball. And I really like this one. Earl Weaver, manager of the Orioles a long time ago, believed in pitching, defense, and the 3-run homer. Well, that's what small and mid caps can be for you. If you do the reading, that's essentially like being the pitcher. Right? If you ever an infielder and you had a great pitcher on the mound, you love being an infielder, right? If you had a bad pitcher on the mound, you hated being an outfielder. But your research process is basically your pitching. This is where on the small and mid caps, if you actually do the reading, you can get an edge. Now, the folks who are like, what do you think about this or that idea? I don't have a lot of patience for it because I know that you haven't done the reading when you ask a question like that. So every now and then I'll pick on you. And, you'll maybe get mad at me or maybe it'll spur you on to do the reading. I hope you do the reading. So do the reading because that is strong pitching. And teams with strong pitching tend to at least do pretty good. Your defense is kind of how you manage your investments for getting in. What do I emphasize over and over again? Scale in slow, small, and at wide price points. Now, I did that on a couple of stocks that I'm sitting on, Ametis being the number one position, and I've been waiting a long time. It's been a drag on my portfolios for 3 years because it's essentially been dead money. Plus, I hold 20 or 30 or 40% in cash, so I really have only had about half of my portfolio firepower working for me at various periods. Yet, I haven't gotten beat up, but I'd like to make more money. I'd like those AST Space Mobiles and Rocket Labs to start compounding even more because I've had other stocks that go up with them. So your 3-run homers are your AST Space Mobiles and Rocket Labs, Palantir. Not really sure why that didn't take. And I think that we own several more. So 2 of the stocks that I've been accumulating, one of them since last spring, right? 7, 8, 9 months now. Again, I just wide price points and quarter over quarter as they make business decisions and they execute. This energy story that I'm in, I think, is potentially 20 bagger on the high side, maybe more, because they were able to buy a bankrupt company, kept the name for $45 million. And that company at one point had been worth $9 billion. They've had a few mergers and acquisitions, and they're now the fifth biggest player in the space. And they're getting into something that Ford just talked about. So it's a huge total addressable market that they serve, two gigantic total addressable markets that they serve in the energy space. And when you take a look at the fact that they have a good balance sheet and they're profitable already, and now they're the fifth biggest player and they're growing at over 20% per year without big tax incentives, you start to think to yourself, okay, if it makes sense, will it happen? And the answer is usually eventually. I don't know about the next 3 years for anything. So for me, I want to buy super cheap. Well, this company is trading at 160, 170 million market cap, and I could make the case that it'll be worth between 1 and 3 billion 4 or 5 years out. Now, could it be sooner? It could. The government could change some policies and maybe they pass an all-encompassing energy generation tax break for the production of energy. And they say, we're not going to specify oil, gas, wind, solar, geo. We're just going to say, if you create energy, we're going to give you a break. In that case, if that's what they do, and that is what they're talking about in Congress, the Republicans in particular, if they do that and they incentivize energy production, and especially if they incentivize it again at the personal level, which I wouldn't see why they wouldn't, because the richest people will be able to take advantage of it the most, and that's what the government usually does. This company can rally a lot sooner than I think the market is pricing in. The other company is an AI platform for cybersecurity. It's not cybersecurity that added AI. It's a company that completely transformed their entire offering to be an AI that actually is an AI that provides cybersecurity, not only in general, but it manages other AIs so that these other AIs don't have problems. So you have an AI that provides cybersecurity within the AI environment. And this company historically has been an endpoint provider for security, which is basically, hey, you have a system and we'll make sure that at the end of the day, it's okay. They've been getting new orders, annual recurring revenue that apply to the entire ecosystem rather than a specific endpoint for technology companies. The potential growth here, and they're already the fourth biggest in the space, the potential growth here is enormous. It's a gigantic TAM, gigantic total addressable market. If you're reading along with, you know who I'm talking about. And they could pretty easily be a 5 to 10 bagger here. Right now, they are a $5 billion market cap. And they're already trading at a discount on valuation to the amount of revenue that they do and the profits that they could have. Now, somebody questioned me in the chat, said, well, they're doing stock-based compensation. I don't invest in companies that do stock-based compensation. Well, then you've never invested in a tech company, because stock-based compensation is par for the course. It's how they attract talent to young, growing companies, and they make a ton of money when the stock price goes up. So there is an incentive for them to dial back the stock-based compensation at some point. If you'll remember, Palantir, the big complaint about them 2-3 years ago was what? Stock-based compensation, remember? So if they dial it back with the intention of driving up the share price that enriches the employees and the management, that would make sense, right? They're already doing a $200 million buyback, and that will go up because their revenues and free cash flow are going up. They're just turning profitable. So this company is in a gigantic total addressable market, over $100 billion a year. They're only valued at $5 billion. If they capture 10-ish% of the market, they're currently at 14. This is a company that should probably double overnight. But it hasn't, because as they went through the transition over the last couple of years, the market said, we hate them. They're not delivering. Well, they changed how they were delivering their services because they realized about 3 years ago that AI was going to change everything. So just like I said, fracking would change everything in 2011, the management here said AI is going to change everything. We have to change our offering because otherwise it's going to become obsolete. So they got out on the front edge of AI cybersecurity, and now I believe they're the fourth biggest in the space, up with companies like Microsoft. So this is a stock that has been rumored to be a takeover target. And one of the reasons I went over Warner Brothers Discovery with you is after that stock bottomed out, it tripled. If this stock has just bottomed out in the teens, I think it'll probably triple too. Now, can they get even bigger than that? They should be able to double just on a normalization of valuation. And then over about 3 years, double that based on their growth. And they might even double it again based on the fact that they're growing their ecosystem. So not only are they doing the business they traditionally did, but they're rapidly expanding other lines of business. Because companies are saying, well, we're doing this with you, so we'll do that with you too. Kind of like what happened with Palantir. Now, I don't know if this can triple, double, but it might. So do they sell 300% higher, or all of a sudden a 10-bagger? I don't know. But I know that at these prices, they are very, very cheap. They're at the inflection point of profitability. They're buying back shares, at least what they're issuing. And I think at some point, it'll be a net buyback. And I think at some point is pretty soon. All right. That was a lot of talking. What kind of questions do you have for me before we go off to the Christmas week? Starting tomorrow afternoon, I am basically incognito for, I don't know, I think we have things going on every day until Sunday. And then a couple days of work, and then New Year's, which we're just going to stay home this year, it sounds like, which means I get to cook. So I like that. So somebody says that Trump reclassified cannabis and Innovative went down. Well, initially Innovative went up, and now it's given back the gain. Why? Well, they're going to reschedule cannabis to a Schedule 3. I think that is pretty much a definite before the midterms, but there's a process. So it's not as if they rescheduled it today. They just said that we're advancing the process, which had stalled. So probably by the midterms, I think a lot of things are going to hinge on the midterms. They're going to reschedule cannabis as Schedule 3. One of the reasons the stocks move up and down is because traders are just freaking being traders. Because volatility is just algorithms and trading rooms and people going nuts. And to think that in a world where half of the people index, they just dollar cost average, and 70 or 80% of what's left is algorithms, you've got maybe 20% of the population trading out of their minds. They are all trying to get rich quick for the most part, and they're trading against guys like me and everybody that's better than me. So I have for a long time tried to play between the lines of my industry. It's a cover your ass thing. That's why I open the investment letters, because you can listen and don't necessarily have to be as conservative as I have been. Now, I have made the decision in the last year or so to be a little bit more aggressive, to reach out to my clients and just say, hey, look, this is what I'm thinking. Sending out an email here and there saying, hey, give me a call. Let's talk about it. I've had several new clients come on and say, be aggressive with me. And I'm going to try to do that. But I think the trade over the next year is to flip it. That's a term that Cody Willard used to use when he was on Fox Business. I know him. And you're trying to flip things. You're trying to say, okay, when can I buy it cheap and sell it expensively? And right now, there's only a handful of ideas out there. This is not a target-rich environment. This is a very target-poor environment. So to use cannabis as an example, I would not buy a cannabis ETF. The reason why I buy Innovative Industrial is a 14% dividend that's very secure, right? Now that they've expanded into healthcare, and they're getting a much bigger return on that $1 billion they have in cash than they did before, right? Before they had $1 billion of cash making a money market rate, short-term treasury rate. Now they're getting 12% on it because they have medical leases that they bought cheap, right? They didn't buy expensively. They bought distressed assets and they're getting 12%. And as they, make the portfolio a little bit better because they rent more things out at higher prices over time, which is absolutely coming in healthcare, which goes through cycles. I think that stock shows very good financially over time, right? This next quarter will be the first reporting quarter for that. And they are owed rent. Think like Vici. Vici collects rent from the casinos, right? From the gambling companies, from Caesars and MGM. Now, Vici has loaded themselves up with debt, and that's a problem. But their initial growth phase was huge. Why? When we went through COVID and people didn't go to Vegas, did the casinos stop paying their rent? No. Do you know what their payment rate was? Does anybody know what the casino's default rate was? Do you know how much of their rent they paid during COVID? It's a nice round number. They paid 100% of their rent. Nobody skipped a rent payment. That's how much money is in gambling. Well, the same thing with cannabis. And now that we are literally bombing drug dealers, and if anybody who thinks that the Mexican cartels aren't next is out of their mind, I have it on pretty good authority that's already happened. You start going, the domestic cannabis industry is in pretty good shape. Well, Innovative Industrial rents out to 23 or 24 something cannabis producers. Why would I want an ETF when I can just get the rent from all these guys, get a 14% dividend, and then when this stock re-rates, it goes to somewhere between 100 and 200. It was as high as 200 before. I think it's going to get there again. But 14% dividend from these prices? I mean, are you kidding me? I'll double my money in 5 years if the share price doesn't change. So that's the way I think about cannabis. Anything else before we go on Christmas break? Yeah, somebody asks about Enovix. Everything that I told you about Enovix months ago is coming to pass. So what they can't tell you is what I've been telling you, which is that their licensing business and U.S. expansion is probably going to be pretty big. I don't know where I mentioned this before. If it was last week, I might have mentioned it. Maybe I didn't. Or maybe I wrote about it in the chat. I don't remember. But Jim Farley was just talking about the opportunity in batteries. Well, that's Enovix's playground. So I think the EVs are not dead. I think the small devices get replaced. I think that AI and AR and VR have huge synergies. When I have a 92-year-old uncle telling me to try VR, it's a thing. It's not even a joke. That's the conversation we had. Have you tried this VR? I'm like, not much. I mean, I have, but I don't play with it. He goes, I've got a flight simulator now on I think he's got an 85-inch TV. I fly that airplane, man. It's like you're there. Your body feels like it's moving. He's tried both the Meta and the Apple VR sets. He likes the Meta one better. So, mainly because he said they're the same, but Meta's cheaper. So why would he buy Apple? Yeah, I think that there's some interesting things out there when it comes to Enovix. And I think that the deals that they get on licensing are going to blow people away because they're going to get to collect maybe half of the margin that they would otherwise have collected, but with zero capex. It's a big deal. So we started out today talking about Rocket Lab. I don't think you have to take any gains this year. I think writing covered calls to January or February, probably a pretty safe bet. If they expire and you want to take some gains, go ahead. One of the things that I'm talking to a few people about, and it doesn't really apply unless you have pretty serious embedded capital gains that you'd like to diversify. There is an ETF that's gotten through all the regulatory processes over the last few years, and they're offered in sequence. So there's an offering on these ETFs, and you can exchange highly appreciated assets into the ETF. And then you get either an S&P 500 ETF or you get the one from Cambria is going to be the Global 500. So where does that make sense? If you have a 6 or 7 figure gain in a stock or up to 5 stocks, and then you have other assets that you can bundle in, there is a way to structure this, and it's not just one for one, but there's a way to structure this so that you can take highly appreciated assets, and you got to follow a formula so you're not violating any rules, and then you can get an index fund out of it instead. That makes sense if you want to diversify out of the highly appreciated asset. If you don't want to diversify out of the highly appreciated asset, then it doesn't make sense. But if you're looking to diversify out, you do the math and you figure out where things land. And this new approach called a 351 exchange is pretty interesting. I think it's mainly for people who have very highly appreciated stock. I just talked to somebody from Micron. They had 7 figures in Micron stock, and they don't want to take the capital gain, and they'd be happy just to put some of it into an index. Again, I think this one will be the global index because most Americans are underinvested globally, but rightfully so for the most part. So if you have highly appreciated assets, right, like 6 and 7 figures, get a hold of me because there might be something interesting that you can do, maybe in a really good spot this spring. Comcast, yeah, I still like Comcast. Where are we at here? Let's pull up a chart. I think that Comcast, can double, right? I think it can get back to its highs at some point. Probably take a while, and they pay a pretty good dividend. The problem with a lot of companies is the capex and the ongoing spend. And I'll be honest with you, it's taken me a really long time, maybe longer than it should have. Maybe not. I know maybe I'm right where I should be, but I just don't have a lot of love for high capex companies anymore. I mean, I just really have moved away from it. And this is a lesson that took decades. And learning about how, in the last piece I wrote about network effects and things like that. The reason why I really like the 2 companies I talked about earlier today that are in the article is that they can, and Enovix, is that they have ways of controlling their capex and creating long-term recurring revenues. With SunPower and Enovix, it's either licensing fees or monitoring the energy. Oops, I said it out loud, didn't I? Dang. With the AI cybersecurity company, that kind of stands there like a sentinel, like one sentinel on guard duty. It's just, once it's built, you just sell it. And that's the beauty of subscription revenues, right? That's why I can do what I do, say what I say, write what I write. And if I'm writing it for 10 people, it's no different than if I'm writing it for 400. So while I don't write as much as I should or could, I've always taken the Hemingway approach, try to say as little as possible in writing so that people understand it and can digest it. And you've all told me that that's one of the main reasons you like me is I try to make it understandable. It's easier to read than some of these guys who write, in 7th grade chunkiness. Take a little bit of pride in the style. So, I think that when we look at these, a company like Comcast, I like it. Do I love it? No. But if you're just looking for those 4 and 5% dividends with very low downside, I think the Comcast is one of them. But once it gets into the 40s, you're accepting higher risk again. So I think you just ask yourself, is it one of my 20 or 30 best ideas for what my goals are and what my risk tolerance is and what I'm trying to do? For me, I've just decided I'm going to be a growth investor forever. Till the day I die, I'm going to be looking for growth. Why? Because either I'm spending it someday or I'm buying something with that money or I'm giving it away. It's different. Look, I was pretty broke in 2015 and 16. And I say that not because I was really broke, but because I had lost half my money and really screwed a couple things up and got some really bad luck. And really the bad luck was the worst of it. I made all that money back pretty quick. But when you have 5 figures, you start to think things are getting better, but I'm still a long way away. Then when you get to 6 figures, you're like, things are getting good pretty quick. I can see the light at the end of the tunnel. Well, that's probably bad. I can see the gold at the end of the rainbow. Then when you get into the millions, you start thinking, now what do I do? And when you make more, you go, oh, what should I do? What are my responsibilities with this money? And I know some people younger than me who are where I'm at, and they think about it differently. I don't know that they have the perspective, even of children in a couple cases, much less grandchildren. So when you think about your wealth, I just think that there's a progression. And some of you are 30 with $65,000, and some of you are 75 with, you check the box for over 15 million, right? I mean, that on my paperwork, that's the last box, over 15 million. And I know ballpark what everybody has. In some cases, I'm probably only within 10 or 20 million, but the point is that as you grow your wealth, you will think about it differently. So apply that to Comcast. What really is your goal? What are you trying to achieve? And I've told you I'm hyper aggressive by regulatory standards. I don't think I'm hyper aggressive by Warren Buffett's standards. I don't, because he's always run a very concentrated portfolio. And some of the other big winners, some of the guys who became billionaire investors, look at Bill Ackman. No matter what you think about him, he's been a great investor, even though he's been imperfect. He's made billions of dollars. Take a look at Gunlock or Druckenmiller. You take a look at all these, you might not like them, but they have done things with money. And the one common thread has been focus, has been concentration. It hasn't been broad diversification. The only reason, and I'm telling you, and I wrote an article about this at one point, and it got very bad reviews. One of the only articles I've ever written where people told me I was an asshole. I get it called an asshole at poker all the time, but they called me an asshole because I said the reason why Warren Buffett says for most people to index is because they're crappy investors. So now we have a lot of people who just believe that it's the best way to invest when really it was kind of an insult. I mean, I've been hanging around the index with half my money invested. Some of my accounts that are aggressive have done much better. In fact, my aggressive accounts have done the best. And I've been moving in that direction, just trying to pull everybody along and, make sure that I clear it just in case I make a mistake or things go wrong. But that would be my piece of New Year's advice for everybody is really think about the types of investments you want to be in for your goals and risk tolerance, and think about how dangerous high capex companies are, especially those that need financing. Now, weirdly, I'm in a couple of those. Why? Because I think that they're way oversold. I think that the price is way below the actual risk. Even though there's risk, I think the price is way below the risk. In the case of Ametis, I think that's true for sure. And if New Fortress Energy refinances their debt, it's for sure true too. New Fortress Energy can be a $30 stock pretty quickly if they get a good debt deal. Ametis, as soon as they start selling those tax credits, they can be a $30 stock pretty quickly. And yet they both trade under two. There are hundreds of millions of dollars in these companies. I mean, they're not pipsqueaks. They're small, but they're not, startups. So when you measure risk and you're looking for asymmetric upside like I am, you just look for great potential ideas. You try to look a few years into the future. Sometimes a few years isn't far enough. And you just try to buy way cheaper than anybody else would ever buy. It was luck. I think pure luck. And most people won't tell you that it's luck. But I think it was lucky that we got into AST Space Mobile and Rocket Lab when we did. And they went up within, a year? I took a lot of heat for about a year because those stocks chopped around 3, 4, 5 for a while. The heat that I took lately is when I told people to take profits on AST Space Mobile between 50 and 70. We just had, and we'll talk about this next week, so I'm going to do a full year option review next week. We just had options on AST Space Mobile expire they were $50 strikes. Got $5 for those. 10% in 2 months. That's annualized 60%. Could you live with an annualized return of 60% over and over again? That's why selling cash secured puts is such a good deal. You can use the volatility on these charts, right, to do things. I don't have it up right now, but take a look at AST Space Mobile. Just take the 1 year chart. Was this not an opportunity to sell cash secured puts? Actually, That was an opportunity to sell covered calls, opportunity to sell cash secured puts, opportunity to sell covered calls, opportunity to sell cash secured puts, covered calls, cash secured puts, and I think covered calls again. You are piling up premium, and I'm going to show the whole chart for the whole second half of the year of all the money that can be made piling up premiums. And then you take a look at the annualized returns. And then you think about, I've had 30-40% of my money in cash pretty regularly. And I got a big position that's been dead money for 3 years. Still not losing. How did that happen? Right? So I think that AI, cybersecurity, robotics, some of the cheap drone makers, drones in general, I think there is not really a super trend out there that will play out the way the AI did. But I think that there are places where a lot of money is going. People don't want to hear it. They don't believe it, but clean energy is one of them. Batteries in particular, but solar could be a big deal too. I mean, it just keeps growing. People focus on the tax breaks in solar. Oh, the tax breaks are gone, so solar is going to die. Solar is as cheap as coal. The problem is the battery storage. Well, suddenly the battery storage is better. So if you can have solar for the same price as coal and eliminate all that pollution, which isn't just what you put in the air. I mean, have any of you ever gone to see what happens to coal sludge? We had a whole bunch of it spill into Lake Michigan a few years back. It was horrible. If you go on YouTube, you can see a couple places where the reservoirs of the coal sludge broke and wiped. There was one city in Pennsylvania that got wiped out, right? The coal sludge just went right down Main Street. So I think robotics is a big deal. We talked about some of those lately. Clean energy, the industrial trade that everybody talks about is broad, but it should be narrow. I think the story with Ford is going to play out. How many times did I tell you that eventually Ford was going to be a conglomerate? And that's exactly what Jim Farley talked about last week on Bloomberg. Expanding into defense, expanding into batteries. Honestly, the biggest headache for Ford, for Jim Farley at Ford, has been the Ford family, I think. They need to just shut up and be silent partners. They just have to have nothing to do. They shouldn't be chairman of the board, maybe chairman emeritus, but they just need to get their fingers out of there because they're just not qualified anymore. I don't think the guy that's in there now is qualified. I don't think his daughter's qualified, right? None of these people ever worked on an assembly line. If they were super smart, they'd figure out a way to get in bed with Tesla or Lucid. Tesla because you get Elon Musk. Imagine if Ford and Tesla merged, what would happen? You'd have a $2 or $3 trillion stock overnight. So, that won't happen because the Ford family controls too many shares, and a lot of people don't like Elon. But when you think about what Ford can become, and they trade at a fraction of the market cap, two things should jump out at you. One, Tesla's going to come down, and two, Ford's going to go up. Do the lines ever cross? I don't know. But I think it's if you were going to make a pair trade next year, that'd be the one I made. I'd be selling Tesla to buy Ford. All right. Take a look at last week's stocks of the week, which I'm going to try to get 3 of those out a month. There'll be something else the other week. I think those drone stocks, Unusual Machines is up like 15% today, isn't it? So I told you to buy that last week. What is Unusual Machines doing today? They got another military contract or something, didn't they? Okay, and then you have Aero Group, and they jumped up today too. I know that they is this all off the production facility starting to pump out drones? Because that's what happened on Friday. So yeah, Aero's up 14% today. All right. Next week is going to be all about the option selling. I'm going to show you the whole history from July to the end of the year and just how much money you can make and why you should be incorporating it into your strategy. Because if we get volatility next year, I mean, you might be able to, Look, my best year was 2009. People are like, how did you make money in 2009? Remember, I was shorting the banks in 2008. And had I understood what I was doing better, I'd have made a lot of money instead of, just, making a low return, low positive return when everybody else was getting crushed. In 2009, I was largely cash. And then in March, I started buying the crash, the end of the crash. When everybody said it was going to get worse, some people were ragging on Obama. Other people didn't understand what Ben Bernanke was saying. I had read his book, so I knew. And I started buying a ton of stuff in the spring of 2009. I was up around 90%. I almost doubled my money that year as a regulated guy. My personal money, I like quadrupled. Again, because I can own 5 stocks and nobody says anything to me. I think a flip trade like that is coming. I don't know if it's 26 or 27 or 28. Maybe it happens twice. You might have to be a little bit more nimble. But if you're selling cash secured puts and recycling that money, right, pretty consistently, always having something expire every month, and then deciding whether or not to reinvest it right away, you really are building in a huge margin of safety by having that option wheel going. And that is what we're going to talk about next week. All right, I will get these edited. Everybody take care. Have a wonderful holiday, whatever it is. If you're Christmas, if you're Hanukkah, Festivus, whatever you are. It's actually my brother's birthday today, so I'm going to send him a message that says happy birthday and Festivus for the rest of us. Seinfeld reference. All right, everybody, have a good one. Thank you.